Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our January 2024 monthly market update. Before we begin, we want to thank our value clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right into it. A lot to cover. Let us first of all wish all of you and your families a very happy new year. We hope to see many of you. We're expecting over 100 in attendance next week at our Perry's Quarterly Investment Forum. So what is the outlook for 2024? Maybe it's something like this, and now the weather is, it will be sunny unless it rains. So that's the way predictions work sometimes, but let's look at kind of where we ended 2023 and what that looks like for 2024. So we ended 2023 near all-time highs at just under 4,800 on the S&P 500. This is where former peak was in early 2022. We also saw a very narrow market, 7 stocks driving most of the market last year. The good news is that did widen out by the end of the year. So if you looked at these 7 stocks, end of May, you were talking about really all the return was coming from those 7. As you move from September into December, still a heavy contribution of the Magnificent Seven to the S&P 500, but still a widening out compared to where we were in May. You also saw a historical 2-month period of time for bonds after bonds disappointed for most of the year. As rates went down in November and December, bonds appreciated. So going back to 1926, the 7th best 2-month periods of time in almost 100 years. We'll soon be talking about the elections this year. In a presidential election year, this is what first, second, third, and fourth quarter average. Of course, they sometimes higher or lower than this, but this is kind of in a presidential election year, you expect a slow start and a better second half of the year if this holds going back to 1926. On the jobs front, over 200,000 jobs added, although revisions were down, so not quite as strong as the 216 would indicate. The last reading on CPI year over year was 3.4%, which means we're a long way away from where peak was in in June of 2022, where we were over 9%. So we're still a long way away from kind of where the Fed's target at 2% is, but nonetheless, a significant move in the right direction from where we were annualized June of 22. So what's next for the economy? There's this long predicted recession that hasn't yet happened. So how the market and how the economy is doing is dependent on who you ask. Consumers, 70% believe a recession is coming. If you look at banks, they're disparate. Bank of America, 35 to 40%. Goldman Sachs believes only a 15% chance. CEOs, interestingly, are much more pessimistic as it relates to there likely being a recession. So what's next for the U.S. economy depends on who you ask, but many are still predicting some form of a recession in the next 12 months. And there's different perspectives of that. So on the case against a recession, the higher rates haven't significantly impacted consumer spending, although spending has slowed on non-essential. The case for a recession is household debt. It hit record highs of 17 trillion in March, a roughly 20% rise year over year. So how long the consumer can afford this, and the consumer drives 70% of our economy, remains to be seen. GDP, we did grow quarter over quarter. So the recession, at least for 2023, didn't happen. Again, the consumer driving 70% of the economy. And so where the consumer is matters. And what we've seen based on debt and based on rates on that debt, you've seen household debt payments as a percentage of income go up. So that's just under 10% now. And you've also seen delinquencies pick up, specifically in auto and credit card rates. So Again, how the consumer is faring with a lot more debt than 12 months ago and at a higher cost remains something to be seen. So the Federal Reserve, after raising rates aggressively, will likely be cutting at some point in 2024. The average length of time between the last raise to the first cut is 10.5 months. The last raise was July of 2023, so that would put it in the summer period of time if averages hold. And if we look at returns following the last interest rate hike, which again was July of 23, we see pretty good 12-month performance for stocks and bonds. And this is kind of the probability on when the Fed will cut interest rates. So this meeting has already passed. So they did nothing. So that 99.7 is 100%, near 100% at the end of this month in terms of a rate cut. But then as we move from spring to summer, the chances of a rate cut go up dramatically. So we're probably looking at, somewhere in the neighborhood of late spring and into summer, a rate cutting cycle beginning. And this is where bonds and cash have performed over before hike, which we're already through with this. If we believe that July of 23 was the last rate increase, which we do for this cycle, pause period, which is what we're in, which favors bonds, and then 6 months after the first cut, which again, we're not at that point yet, how bonds and cash perform. And the reason we bring this up is one of the interesting phenomenons now with cash actually paying you something. Cash is an overall weight that's the same as bonds with all mutual fund, ETF, and money market assets. We haven't seen that before. You see this line going back 10 years. The last time it was close was 2012. Now we're at parity with overall bonds and overall cash. And the next slide is just going to talk about how quickly money market rates can fall. So this is from March of 2001 to July of 2002. 16 months, money market rates went from paying you 5.8 to paying you 1.8. So a dramatic drop over that period of time. Another period of time where money market rates fell dramatically was fall of 07 to January 09, where they went from 4.7 to 1.7. So money market rates, which are attractive today, can fall quickly as rates fall. And this is just a much bigger look. This is looking at markets going back to 1926. And we talk about investing for the long term. This kind of captures this. We look at going back over the 70 and now 98-year period of time. You're looking at 72 of those 98s being positive, with 26 being negative, and all these negatives are painful. You also look at the momentum is almost 2 to 1, with the average positive return at 21 and the average negative at negative 13.4. So none of this is a replacement of contacting us directly to talk about how all of these things apply to you specifically. So please leave no question unanswered. Please ask us. We're here to serve you. So with that in mind, we will close. Again, we want to wish each of you a very happy new year. We hope to see many of you next week at our quarterly investment forum. Until we see you again, be well and take care.